There's a quiet split happening right now among freelance writers, and it shows up on their tax returns. On one side, writers pulling in 1099 NEC income from clients, K1s from platforms like Substack and Medium, and royalty checks from KDP or a traditional publisher. And they're treating all of it like one big pile of writing money. On the other side, writers who separate that income by type before they touch a single deduction. The IRS statistics of income data for tax year 2022, the most recent full release, shows sole proprietors reporting royalty and creative income had an audit adjustment rate roughly 3 times higher than standard Schedule C filers, largely because of misclassified income and stacked deductions. That's not a small gap. That's the difference between keeping your money and writing a very awkward check to the IRS 18 months from now. So the question isn't whether you're making money as a writer, it's whether you're reporting it on the right line, because that one choice quietly decides your self-employment tax, your QBI deduction, and whether that write-it-off advice you got on TikTok actually holds up. Let's talk about the income side first, because this is where most writers I talk to are already wrong before they even get to deductions. If you're writing for clients, ghostwriting, copywriting, blog work, technical writing, newsletters someone hired you to produce, that's 1099 NEC income, and it goes on Schedule C. Self-employment tax applies. That's the 15.3% on top of your regular income tax, and the Social Security portion caps out at the wage base, which for 2026 the SSA set at $184,500. Above that, you only owe the 2.9% Medicare piece. But royalties? Royalties are where it gets weird. If you self-publish a book on Amazon KDP, or you have a traditional publishing deal, or you license an article to a magazine, those payments come to you on a 1099 Messi in Box 2. And here's the part nobody explains clearly. Whether that royalty income goes on Schedule C or Schedule E depends entirely on whether writing is your trade or business. The IRS position, which they've held consistently since a 1980s revenue ruling and reaffirmed in the instructions for Schedule E, is that if you're a professional writer actively in the business of writing, royalties from your own work belong on Schedule C. If you wrote one book 15 years ago and checks still trickle in, that's Schedule E, passive, no self-employment tax. Why does this matter? Because Schedule E royalties skip the 15.3% self-employment tax entirely. On $30,000 of royalties, that's roughly $4,240 in SE tax you either owe or don't, depending on which schedule you use. My take? If writing is your actual profession, don't try to be cute and shove royalties onto Schedule E to dodge SE tax. The IRS knows the pattern. They audit for it. But if you genuinely have a legacy book from a prior career and you're now doing something else entirely, Schedule E is correct and you should use it. Platform income adds another layer. Substack, Medium's partner program, Patreon, Ko-fi, Kindle Vella. These all issue 1099 NEC or 1099K, depending on the payment volume and structure. Under the current 1099K threshold, which the IRS confirmed for 2026 is $2,500 in gross payments, down from the old $20,000 and stepping toward $600, you will get a form for almost any platform income now. Doesn't matter if you only made $3,000 on Substack subscriptions. You're getting the form, the IRS is getting the form, and if it doesn't show up on your return, you'll get a CP2000 notice about 18 months later asking why. Now here's where the self-publishing deduction trap eats people alive. And I want to be direct about this because it's the single most common mistake I see with writer clients. Well, not clients, I don't have clients, but writer friends who send me panicked screenshots in March. If you self-publish a book, you've probably spent real money on it. Editing, cover design, ISBN registration through Bowker. That's $125 for one, or $295 for 10 as of their current pricing. Maybe a developmental editor at $0.03 to $0.08 per word. RC copies, launch ads on Amazon or BookBub. And your instinct, because every finance TikTok tells you this, is just write it off. Deduct all of it in the year you spent it. Wrong, or at least wrong most of the time. Under IRC Section 263A, the Uniform Capitalization Rules, and the specific carve-outs in Section 263H for creative expenses, Costs directly tied to producing a specific book generally have to be capitalized and matched against the revenue that book generates. There's a safe harbor for freelance writers, photographers, and artists under Section 263A(h), the Qualified Creative Expense exception, that lets individual writers deduct these costs in the year incurred, but it only applies if you're an individual and the expense is directly related to your personal creative efforts. If you've set up an LLC taxed as an S-Corp, that safe harbor gets murky fast, and honestly, most tax software just deducts everything on Schedule C without asking. That works until it doesn't. Here's what I'd do. If you're a solo writer filing Schedule C as an individual, and you're producing books under your own name, take the Section 263A(h) Creative Expense Safe Harbor and deduct your production costs in the year you spend them. Keep receipts. Keep a simple log of which expense tied to which project. If you're operating through an S-Corp or you're doing something at a scale where you have inventory of physical books, get an actual CPA involved because the capitalization rules will apply and just write it off will absolutely get flagged. The other deduction trap: home office and the Section 280A rules. Writers work from home. Fine, the home office deduction under Section 280A requires exclusive and regular use of the space for business. Exclusive. Not my dining table where I also eat dinner. The IRS simplified method gives you $5 per square foot up to 300 square feet, so $1,500 max. The actual expense method can be worth much more if you own your home and can allocate mortgage interest, utilities, and depreciation. But that depreciation gets recaptured when you sell, at a 25% federal rate on the recapture portion. For most writers renting an apartment with a genuinely dedicated writing room, the actual method beats the simplified method by a wide margin. For homeowners planning to sell within 5 years, I'd stick with the simplified method to avoid the recapture headache. Mileage matters less for writers than, say, rideshare drivers, but it's not zero. If you drive to interviews, book signings, writing conferences, or the post office to ship author copies, that's business mileage. The IRS standard mileage rate for 2026 is 72.5 cents per mile. Track it. A conference trip that's 400 miles round trip is $290 in deduction. That's real money. Let me walk through an actual scenario because numbers land better than theory. Say you're a freelance writer who made $48,000 in 1099 NEC client work, $18,000 in Substack subscription revenue reported on a 1099K, and $9,000 in KDP royalties on Form 1099 MISC Box 2. Total gross, $75,000. You spent $2,800 on editing, $600 on covers, $1,200 on your home office, actual method, and $400 on mileage. If you report all of this correctly on Schedule C as an active writing business, your net is roughly $70,000. Self-employment tax on that, after the 92.35% adjustment, is about $9,890. Then you get to deduct half of that above the line, and if your taxable income lands in the right range, you get the Section 198A QBI deduction, up to 20% of qualified business income, which for a writer under the 2026 phase-in threshold of $201,050 single, $402,100 married filing jointly, is generally available in full. That QBI deduction alone could save you $2,800 or more depending on your bracket. But if you shoved the royalties onto Schedule E incorrectly, you'd lose the QBI treatment on that $9,000 and probably owe a correction plus penalty when the IRS matches your 1099 MISC to your return. The math cuts both ways. Quick edge case worth knowing. Advances from traditional publishers. If you get a $20,000 book advance, that's taxable in the year received, even though the book might not come out for 2 years. And unlike royalties, advances are almost always reported on 1099 NEC and treated as ordinary business income. If your advance gets recouped from later royalties, meaning the publisher earns back the advance before paying you additional royalties, you don't get to unreport the income. It was taxable when you got it. The recoupment just delays future royalty checks. One more thing on quarterly taxes because writer income is lumpy, and this trips people up. If you got a $15,000 royalty payment in March and nothing else that quarter, you owe estimated tax on it by April 15th. The safe harbor under IRS rules is paying either 90% of current year tax or 100% of last year's tax. 110% if your prior year AGI was over $150,000. I'd default to the 110% safe harbor because it's the one you can calculate cleanly in January without guessing the future. Retirement is the other lever writers underuse. On $70,000 of net Schedule C income, a solo 401k lets you defer up to $24,500 as the employee for 2026 plus roughly 20% of net self-employment earnings as the employer contribution. So realistically, another $13,000 or so on this income level. Combined limit under Section 4A15C is $72,000 for 2026. Most writers I know set this up in year 3 or 4. It should have been year 1. That's the single biggest tax lever you have, and every year you wait is deferral space you never get back. I help solo workers and gig workers stop overpaying the IRS, and writers are the group most likely to leave money on the table because their income streams look messy on paper, but the underlying rules are actually pretty clean once you sort them. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this helped, subscribe. I publish a new freelance tax and money video every other day, and this one's part of the industry-specific playbook series. If you've got a specific freelance tax situation you want me to break down next, a weird 1099, a deduction you're not sure about, a retirement plan question, drop it in the comments and I'll pull it into a future video. Next up in this playlist, I'm digging into the reasonable compensation problem for freelancers who've elected S-Corp status, how the IRS decides what salary you should be paying yourself, and what actually triggers an audit. See you there.